Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Humaira Nurbani Putri and I'm representing finance team in PTBA, and today I want to present about the capital budgeting and financial feasibility evaluation for the purpose 50 megawatt peak solar PV and 50 megawatt hour battery energy storage systems at PT Bukit Asam at Tanjung Anim Mining Complex, and this is prepared for the investment committee meeting today. So next slide. The PTBS strategic context and the project overview here. PTBS mining operations run continuous heavy electrical loads, overland conveyors, electric shovels, bucket wheel excavators, and today the demand is met entirely through PRN's industrial grade tariff category I3 at roughly around 1,115 per kilowatt hours, and this creates real energy cost exposure. And the proposed hybrid microgrid addresses this directly. 50 megawatts of ground-mounted solar generates zero emission power during peak daytime hours. The 50 megawatt hour battery system buffers voltage and frequency spikes from heavy equipment load change, and the site itself uses post-mining overburden dumps, so there is minimal land acquisition overhead. Strategically, this also accelerates PTBA's net zero emission in 2060 target, while we hedging against long-term peer and tariff inflations. Okay, this is the key financial and operational assumptions. So the total upfront outlay is 195 billion in year zero, around 680 billion in equipment capex and development on and EPC costs, plus 15 billion in initial working capital. Depreciated straight line over the 50 years project life. Year one energy cost savings are projected at 110 billion, growing 3% a year, against operation and maintenance costs of just around 12 billion, and with the tax is 22%, and the unlevered WACC is 10.5%. Three things matter more than the rest of this table. First, because the depreciation life exactly matches the project life. Book value hits zero by year 15, so the entire salvage value becomes taxable. Second, this is deliberately an unlevered, all equity view, standard practice to spread the investment decision from how it's ultimately financed. And third, year one, energy saving is roughly 9 times the size of operation and maintenance, and this is effectively a single variable project. Okay, next, here is how that plays out. The 695 billion initial investment happens entirely in year zero. Operating cash flow starts 86.4 billion in year one after tax and adding back depreciation and compounds upward each year as savings grow. And by year 15, we add a terminal cash flow around 54 billion from working capital recovery and after-tax salvage value. The cumulative cash flow turns positive before the project maturity, which is what underpins the 7.4-year simple payback. So this is the best case valuation and capital budgeting metrics. Discounting all of the 10.5% give a net present value of 54.89 billion and IRR around 11.76% and a payback around 7.38 years. And the profitability index is around 1.08 times. Every formal hurdle criterion is passes, and this is 54.89 billion in value creation above the PTBA's cost of capital. And every rupiah invested returns are 1.08 in value. Standard base case decision rules point to acceptance with conditions. I also tested two more conservative variants, which is discounted payback, which discount each year cash flow at WACC before accumulating. Instead of just summing raw cash flow, comes out 13.51 years. nearly the full 15 years of project life. And the modified IRR, which assumes cash inflows are invested at WACC rather than at the IRR itself. This is a more realistic assumptions, come out 11.06%. Still comfortably above the hurdle rate, but more conservative than the headline of the IRR. I also want to flag the vulnerability this points to directly because it matters for everything that follows. The IRR buffer above the WACC is thin. It's only about 126 basis points, and the 13.51-year discounted payback tells the same story from a different angle. This project only becomes value accretive on a time value money basis in its final years. And critically, this unadjusted model assumes 100 system utilization, zero solar PV degradations, and no battery replacement cost over 15 years. Those very optimistic assumptions, and testing what happens when we relax them is exactly what the rest of this presentation does. So we move to the sensitivity analysis. We test the energy saving against the WACC across a full matrix, which confirm the same pattern from a different angle. And PV rises as saving increase and falls as the discount rate rises. At a 10.5% WACC, a 10% saving shortfall alone is enough to push NPV to negative. The more severe combination, which is 20% saving shortfall at a 12.5% WACC, destroy roughly around 162 billion in value. And the best case, which is 20% higher saving at an 8.5% WACC, would nearly triple best case value. So the takeaway for the committee is the same as scenario analysis. Energy savings realization is the variable that most needs protecting. Move to the next slide. This is where the analysis goes beyond what the case required, and it's the most important section of these presentations. And on the operating side, I layered 4 realistic operational fraction inputs, which the base case previously ignores, with 90% utilization factor, which accounts for the cloud cover and dispatch limits, and 0.5% per annum for PV degradation for the annual capacity loss on solar output, and 0.4% capex per annum, and it's at 0.2% per annum for the asset insurance, and outlaying at year 8 for the battery augmentation at 102 billion replacement. It is 15% of capex. So combine this push together to an EV negative 137.76 billions with IRR dropped to 7.04%. On unlevered standalone basis, that's an outright reject. But then I restructured the financing into 60% of debt with the commercial 8.8 interest rate and 12-year principal amortization, with the interest tax shield after tax cost debt with 6.86%, and together I recalculated the WACC reduced from the 10.50% to 7.88%. Under that lever structure, even with all 4 operating risks included, NPV recovers to positive 28.40 billion with IRR 9.1%. And critically for a lender, minimum year 1 DSCR comes in at 1.45 times, and the average project will be 1.57 times, both comfortably above the 1.35 times confidence. So I can say that this project is bankable. This chart makes the point visually. Base case unlevered sits at positive 54.9 billion. Layer in realistic operating risks unlevered and it falls to negative 137.8 billion. A clear reject for on its own. But applying 60% leverage structure to the same risk-adjusted case, the value recovers to 28.40 billion rupiah. And when we utilize the green bond at 6.0% interest rate per annum, the NPV boosts to 50.98 billion rupiah. The insight that I would like to underline for the committee here that the leverage here isn't just a return enhancer. It what keeps this project financeable at all if all the risks that I just described actually materialize. That's arguably the single most important finding of this entire analysis. So move to the next slide. I added one more dimension which I focus on the carbon and ESG value. So this project avoids an estimated 77,937 tons of carbon dioxide equivalent in year one. It's around about 1.17 million tons over the full 15 years life, calculated by converting the 110 billion in avoided electricity purchases into implied energy volume, then applying Indonesia's official grade emission factor. If registered under Indonesia carbon trading mechanisms, that's worth somewhere between around 35 and until 61 billion. So I want to be direct that this isn't in the official NPV because it requires carbon market registration to become liquid gas. So strategically, through this matter beyond the financials, as a coal producer, PTBA is under real pressure to diversify into lower carbon energy, and this gives the committee concrete measurable emission metrics independent of monetization plus embedded optionally if Indonesia's carbon market is matter further. Next, move to the last slide, which is recommendations. And after all the analysis we have done before, the main question will be should PTBA invest? I can say yes, but with conditions. The best case NPV is positive and the IRR, also the modified IRR, clears all the hurdle 10.5%. And the main source of the value is the year one energy saving of 110 billion, which is growing 3% a year. And it is 9 times larger than operation and maintenance costs, effectively the entire project. And the downside risk is the energy saving shortfall, which still dominates. It has 1.6 times the NPV effect of the equivalent WACC shocks, and combined with the battery insurance and degradation risks, flips NPV to the negative 137.8 billion. And how robust under unfavorable assumptions? Moderately. It survives in the best and optimistic and any single shocks, but fails under full pessimistic or full combined risk condition. To 60% of debt financing with 8.8% interest restores the positive NPV to 28.40 billion, even in the combined risk case. And my final recommendation is investment conditions. Specifically, do not build this as 100% equity and approving 60% project finance structure subject to strict contract de-risking and low capex via turnkey lump sum EPC contract at 680 billion and securing a minimum 90% yield performance guarantee to protect the 110 billion savings estimate. I also recommend to pursue concessional green debt financing to lift equity returns and offset combined risk exposure. And the last recommendation, I would like to recommend to register the project for the carbon credits to the ESG value streams and to maintain the transition of agenda of PTBA. And that's all my presentation today. And I hope my recommendations and analysis would be consideration for the investment committee to decide whether we can continue with this project or not. Thank you, everyone. And if you have any questions, you can raise your concerns directly to me and put your comments here. Bye.